Yeah, hi, thank you, Malika. Good morning, everyone. On behalf of HDFC Securities, we welcome you to the Q1FY22 earnings phone call of Prince Pipes and Fittings. From the management team, we have Mr. Parag Chheda, Joint MD, Mr. Shyam Sharda, Chief Financial Officer, Mr. Anand Gupta, Deputy Chief Financial Officer, and Mr. Nihar Chheda, Vice President Strategy. In this call, I now hand over the call to Mr. Parag Chheda for his opening remarks, post which the moderator will open the floor for Q&A. Over to you, Parag sir.
Yeah, thank you, Rajesh, and a very good morning to all. Thank you for joining us for our Q1 FY22 earnings call. Hope you and your families are safe and well. The presentation and the press release have been issued to the stock exchanges and uploaded on our website. I will be keeping my opening remarks in brief so that we can have more time for Q&A. In Q1, we had a revenue growth of 9% and a volume degrowth of 26%. Operating margins stood at approximately 12.5%. Our results were impacted due to three reasons. Firstly, as we had indicated during the last quarter's call, we took a strategic decision in March that we wanted to have a high product availability in the market due to the uncertainty of a potential lockdown. Also, with the anticipated decline in PVC prices, we kept our capacities running high to produce and sell to align with the above goal. Hence, in April, the channel inventory was relatively high. Secondly, due to the restriction of the second wave, both the urban as well as the rural markets were impacted. Lastly, agri demand was muted. However, the plumbing and the SWR segments continue to deliver. Also well supported by the strong inroads gained by Prince Flowguard Plus plumbing systems in the urban, semi-urban and tier 2 and 3 regions. Moving forward, June performance had been better than May and July performance had been much better than June. We are returning back to our regular growth trajectory. We are moving in the right direction with strong business models. The real estate sector has been reporting positive growth. This augurs well for us, signaling traction piping products. As we progress, sustainability of our growth momentum is our key focus. Alliances and profitable collaborations will continue to play an important role for us across all our operating categories. Aligning with our strategy of winning in many Indias, the Ultratech Building Solution and Prince Pipes synergy is well placed to be a mutually beneficial partnership, especially for the semi-urban and rural markets. The UBS platform has a vast network of around 2,000 dealers, and Prince can now leverage the relationship of registered dealers on the UBS platform. This presence will further expand our brand visibility in our tier 2 and 3 cities and towns, which are growing markets for our segment. Over the past few quarters, we have been highlighting how ESG is core to our overall strategy. In alignment with this, we announced the Ab Ghar Ghar Mein Ganga campaign in Haridwar during the Mahakumbh. As a part of this, visitors were given miniature Prince store-fit water tanks containing holy Ganga water at special booths. We were able to provide a solution to citizens who could now take this holy water back home in a safe and hygienic manner, thus helping the government authorities to maintain the COVID guidelines. Furthermore, the miniature store-fit water tanks signified a message urging people to save water. Through this campaign, we distributed more than 10,000 small tanks with holy Ganga water to family members of senior citizens who were unable to visit ghats during the pandemic. Thank you for your time and mind share. I will now hand it over to Nihar to introduce to you our new product launch.
Thank you. Good morning, everyone. This is a day I have been looking forward to for some time now. At Prince, we have been able to build a range of innovative products consistently catering to applications across the board in a market like India, which has typically been late in the adoption curve of technology and products that are well accepted globally. Right from the 1980s, we were ahead of the curve by driving a shift from GI to PVC pipes for domestic use. In 2017, we were early movers in bringing a global product, double wall corrugated DWC pipes, to replace RCC pipes for underground drainage. I strongly believe that this product will be able to change the face of our sanitation standards across India in the years to come. For us, the next such high performance product is one that will improve the user experience and impact yet another segment. I am excited to introduce Prince OneFit industrial CPVC pipes. We are confident that this product will replace the conventionally used product mild steel pipes for industrial application. OneFit will be licensed from Corzen with our global partner of choice, Lubrizol. This Corzen product of Lubrizol is the preferred industrial CPVC solution across the globe. Now that I have walked you through the high performance standards of Corzen, let me also walk you through the rationale of Prince entering into this segment and the potential opportunity. Firstly, the Indian industrial piping market size is expected to be around approximately 16,000 crores. This is today dominated by the conventional MS pipes. In India today, CPVC is majorly used only for the domestic application, whereas globally, CPVC pipes are very well accepted for the industrial application as well. Thus, I believe there is a tremendous potential for industrial CPVC pipes in the Indian market. Secondly, the industrial CPVC segment is under-penetrated and has low competitive intensity. Hence, this product is an ideal complement to our existing product portfolio. Also, the pipe to fitting and valves ratio is favorable, making this a key value proposition. Lastly, this segment has high barriers to entry because of high gestation periods for orders and the required techno-commercial expertise. This results in relatively high barriers to entry. Prince OneFit will provide an optimum solution to industries such as chemical, power generation, metal treatment, paper and pulp, mineral processing, water treatment plants, among many others. Now, with this new product, Prince is India's first company to have a 3-polymer solution for the industrial application. Easy Fit in PVC pipes, Green Fit PPR pipes, and now OneFit CPVC pipes. I strongly believe we are now in an opportune position to impact the industrial piping segment. Thank you all. I will now pass it on to Shyam to walk you through the fiscal performance.
Thank you, Nihar, and good morning, friends. I will be taking you through the Q1FY22 financials now. In this quarter, the company saw a robust revenue growth of 9% at rupees 331 crores compared to 302 crores in Q1FY21. volumes have reduced by 26% at approximately 18,500 metric tons. EBITDA was at around 41 crores in Q1FY22 compared to rupees 32 crores in Q1FY21, a growth of 30%. EBITDA margin was at around 12.5% in Q1FY22 as compared to 10.5% in Q1FY21, indicating a margin expansion of 200 bips. The profit after tax stood at rupees 18 crores compared to rupees 11 crores, translating to a growth of 58%. This was owing to an overall improvement in performance at EBITDA level, aided by a sharp decrease in finance cost by 60% due to the complete repayment of long-term debt and continuous improvement in cost of short-term borrowings. On the key balance sheet parameters for the quarter ended, we would like to state our gross debt as on 30th of June 2021 stood at 157 crores compared to a gross debt of 256 crores as on 30th of June 2020, thereby indicating a reduction of 99 crores from the previous year. We have repaid our long-term outstanding debt and have become long-term debt-free as on date. Our working capital will improve as markets open up and the inventories will normalize. It has been our priority, 1, to reduce cost of borrowings, 2, move recourse on channel financing facility. While we have been able to reduce the borrowing cost over the past 6 quarters, I am glad to share that we have achieved partial recourse terms on our channel financing facility. We are in the right direction towards achieving our dual goal of customer centricity and a stronger balance sheet. With this, we would like to open the floor for questions, please. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We would like to remind participants that you may press star 1 to ask a question. The first question is from the line of Sujit Jain from ASK Investment Managers. Please go ahead.
Hi. I just wanted to quickly check, Nihar, with you is what is our, you can give that number for FY21. What is our sales mix in CPVC, PVC and others, in agri, plumbing and infra? And looking at the numbers for Q1 of competitors, have we lost some market share?
Sure. So firstly, in terms of the breakup, you are aware that we do not give up segmental data from a competitive intensity point of view, but roughly around 65% is building material, 30% is agri, and 5% is infrastructure. Secondly, on your question of market share, no, we have not lost market share. I think it is not a fair thing just to look at year-on-year or QOQ because the bases are very different for different companies looking at the kind of impact the 2 waves had in the past Q1 and the current Q1. I think the only reason there has been a significant volume degrowth is, like we mentioned, the channel inventory was very high. And if you look at the March quarter, we were actually had a very strong volume growth relative to the industry. And again, like we said, that if you look at the July numbers, I think we are back on our strong growth trajectory. So to answer your question, no, we have not lost market share.
Sure, but is it safe to understand that CPVC would be roughly 65-70%, PVC would be 15-20%, and then the remaining others, without getting into numbers?
PVC would be around 65-70%. CPVC would be around 18-20%, and the balance would be the other polymers.
Yeah. And the other thing is, I was just noticing in your FY20 release, when the cash flow from operation got revised from minus 152 crores to plus 102 crores. So if you can explain that.
So I will take this. Actually, what was done in March 20, there was a point which was mentioned in operating activities against the financial activity, which got recouped in the subsequent quarter. So that was in discussion with the auditor itself. So there was a realignment being done. So the classification was suitably being made thereafter.
So if you can explain further actually what went above the line of cash flow from operations when you declared FY20 results, and then what got recast in FY21 results when you restated FY20.
So it was basically the fixed deposit part of the thing, which was a part of the investing activity, which ideally, should have formed a part of the investing activity, which got clubbed in the operating activity. So that got rightly classified at a later stage with the consent of the auditors. So it was mainly in FDs, which was being raised, the money that we raised from IPO, which was parked in FDs. That classification got changed.
Okay, and one last question is on inventory. If I look at in the P&L, the inventory is high at about 104 crores. Would not just you, but would the industry be staring at some inventory losses if the prices were to go down?
So there is the inventory level is high right now relative to what it usually is. If you see the PVC trend, actually it has started moving upward as demand is normalizing and supply continues to remain tight. There was a slight inventory loss in the June quarter of around 5 odd crores. But I don't see a major threat of inventory loss going forward, simply because PVC will only tighten from here on.
And versus making PVC compound ourselves, sourcing it from, let's say, Lubrizol, at least one player in the industry, the leader in CPVC, is making their own compound. How much margins we forego when we source CPVC compound and then make CPVC pipes?
So it is tough to quantify an exact margin firstly, because this is not a commodity. Every organization has their own sort of contracts with their suppliers, and a price is formed. It is not like PVC where there is a sort of global benchmark pricing or something like that. So it's very, it is impossible to quantify the margin. And for us, I've always stated that Prince was always perceived as a strong brand in the PVC space, also trying to sell CPVC products. So now with this tie-up, we have that inherent first mover advantage and brand equity in PVC. And with Lubrizol, now we get that in CPVC as well, since the FlowGuard Plus brand is still very strong in India. And whatever, definitely our cost would be higher, but I think at the operating margin level, that would be set off as we ramp up market share in a space where we are under-penetrated.
And last question on channel finance, what is the guidance then? What is the exact amount absolute currently?
So we are at around 54 crores in terms of the utilization so far, and we wanted to be slightly moderate over there, because we are also moving, as I said on my call, we are moving to a partial recourse type of a structure. But slow but steady is what we are looking at. So it's around 54-55 crores as on date.
But as a percentage of sales, where do you want to keep it?
So we don't want it to be, I think we should be in the range of around 15 to 20%, around that range, and not beyond that.
Sorry, I didn't get that. 2,000 crores of sales, and 20% of that is 400 crores of sales.
Yeah.
So yeah, I'll take that. It's around 15 to 20% of our distributors are on channel finance, not as a percentage of sale. This is not something that we can have as, fix as a percentage of sale. It is basically, we are very clear as a management that channel finance is something that we don't want to give to each and every distributor. There are a handful of distributors who have a strong credit history and trust built with the company, and only those distributors are on channel finance. This is not something that we are looking to expand on aggressively. The simple point being that only we have moved from full recourse on our books to partial recourse. That is the only change.
So to understand this correctly, the absolute number is what we should be tracking and which remains at 55 crores, and broadly it should remain thereabouts. And we should be focusing on absolute number.
Correct. So it would be range bound.
Right.
Yeah.
Sure. Thank you.
Thank you. The next question is from the line of Madhav Marda from FIL. Please go ahead.
Yeah, hi, good morning. Thank you so much for your time once again. I just wanted to ask on the new product launch which all were talking about, who would be the key customers for this product, and how are the margins and the receivable cycle? Like, does it vary from our existing business or it will largely be the same?
Sure. Thank you, Madhav. So this is still going to be through the channel, but there is no trade as such where there will be no retailers or anything in this space. So, but we will not take any direct exposure. We will still sell through distributors. There are specialized distributors for this segment, industrial distributors, where we already have a decent experience because some of our PPR already is sold through the industrial channel. And if I have to talk from an end user point of view, it would be various industries like, chemical, power generation, metal treatment, paper and pulp, water treatment. So these are the, potential end users that we are looking at. And the gross margins are very favorable relative to our existing portfolio. And that's why I think it's a very good complement to my existing portfolio today, because of the kind of value proposition that we're seeing in this space. So it may not be huge in terms of contribution to the top line, but the gross margin is going to be favorable.
Got it. And the second question was, last year the larger players benefited from, market share gains from the smaller players. Are we seeing any of the smaller players coming back in the market, or it remains status quo and sort of it's still favorable for the larger players to gain share in the coming year?
Yeah, so that's an interesting question, Madhav, and it's something that we internally try to evaluate and brainstorm on that. So if I see what has, to answer that question, it's very important to understand what has caused that market share gain in the first place. It was a multitude of factors, whether it was the sort of cash crunch that the smaller players were facing, the tightening of BIS norms, and now especially post-COVID, the kind of volatility that the commodity of PVC has seen. Today, if I see globally, PVC continues to remain tight. Supply of PVC continues to remain a challenge. And as demand normalizes in the Indian market, I think PVC is going to see an uptrend. The extent of the uptrend is something that needs to be understood. But to answer your question, I don't see the smaller players coming back anytime soon because of this sort of environment.
Understood. And just look for demand for rest of the year, especially on the plumbing and the agri side. How are you all seeing the market shaping up?
So agri now, I think we need to see how it will perform from November onwards, because that will be the next season. On plumbing, I am optimistic about plumbing. The kind of growth that the real estate sector has been showing, I think there is still that underlying buoyancy for real estate demand. Whether it's in urban India or whether it's semi-urban rural India and the affordable housing space. So I am still optimistic for plumbing and SWR, which is anyway 65-70% of our overall business.
And what about the Nalsijal program? Has that picked up in a good way, and is it favorable for a larger player like us to supply volumes there, or are the margins not great, so we want to sort of limit the amount of volume we sell in the market?
Madhav, could you repeat your question, please?
No, the Nalsijal program, we were hearing that it's picked up in a good way in some of the states in the country. Just wanted to understand how are you all seeing the takeoff in the demand there, and is our company looking to sell meaningful volumes, or because margins are lower we might want to limit exposure to that business?
So with government projects, the key thing has always been credit and the receivable cycle, which I think has been fairly disciplined. So we will continue to participate because yes, at the gross margin level, it may not be favorable, but the volumes do help with cost absorption. In the December and March quarter, we did see a good contribution. Of course, in the current quarter, it was slightly subdued due to the lockdown. So we will continue to participate as long as the credit cycle is disciplined.
Got it. Okay. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, please limit your questions to 2 per participant. Should you have a follow-up question, would request you to rejoin the queue. The next question is from the line of Ritesh Chheda from Lucky Investment Managers. Please go ahead.
Yeah. Hi. My question is on with the flow guard coming in the half year last year and now the industrial CPVC side. So over the next 3 to 5 years, how should the CPVC share in our total business should rise? And what is the incremental gross margin in CPVC over our base business of PVC?
So, especially, with the FlowGuard Plus brand now, it is very well aligned with our overall strategy of premiumization, which we began much before our tie-up with FlowGuard Plus as well. So I think now with this tie-up and with industrial CPVC, it may not be a huge contributor in terms of top line, but I think it will help us improve the overall market potential for CPVC over the next 5 to 10 years. I think we need to target double-digit growth in CPVC every year. It's hard to comment on what that will be as a percentage of the overall revenue, but I am pretty optimistic about strong growth in CPVC from here on.
On the incremental gross margin there?
I cannot comment on segmental margins, but CPVC is a value-added product for us, and focusing on CPVC will improve our product mix, which has been a lever for margin expansion and will continue to be a lever for margin expansion.
Okay. My second question is, there has been a lot of volatility in your margin, what we saw in the last 3-4 quarters now. What would be your best guess incrementally on the margin profile, either percentage or EBITDA per kg, whatever you are comfortable with, over the next 12 months, and what kind of volume growth at the company level is what you see?
Yeah, so I think firstly, if I see last year, of course, the margins were strong because of multiple reasons, like improving pricing power, better product mix, and inventory gain. All three led to a increase in margin in the past financial year. Of course, this last quarter, the margins have reduced because of a small inventory loss. Even the sales was fairly muted, so we did not have the usual cost absorption benefits as well. So there are enough and more levers for margin expansion. What we have been consistently talking about, whether it's pricing power, value-added product mix, which will only improve with such new launches like the industrial CPVC. And operating leverage would be our third lever for margin expansion. So we need to keep working on these three segments, and that will lead to strong margins going forward. And I'm sorry, I missed the last part of your question.
Volume growth expectation?
So volume growth, I think, again, we are very confident that the real estate segment is underlyingly buoyant. We are also going to be making market share gains, whether it's from the unorganized segment or from other organized players, because of the kind of network expansion we've been working on, because of the kind of branding investments that we've made. So whatever the industry growth is, over the past few years, we have been able to outpace industry growth by 2 to 4%. And I am confident about that continuing over next few quarters.
Mr. Clarification, your margin answer, the reference there for expansion, is it the expanded margin of 17% which you reported in 21 and there is a expansion case by virtue of mix, operating leverage, etc.? Or your reference is something else?
No, I'm referring to FY21 margin, where there was the pricing power, product mix and inventory gain. So that is talking about FY21 on an annual basis, the EBITDA margin.
And your reference is there is an expansion scope over that 17%.
No, I'm saying that has expanded to 17% because of these levers, and we need to continue working on these levers going forward.
Okay. Thank you very much, Niyar. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Chirag Lodaya from ValueQuest. Please go ahead.
Yeah, thank you for the opportunity. So just one clarification on margin. So first, how you look at your margins internally? Is it more EBITDA per kg basis or it is percentage of sales basis? How you internally evaluate this?
So we internally evaluate on percentage and per ton basis. But in terms of discussing it with external stakeholders or any projections, we would stick to a range in percentage terms.
Okay. And just a clarification, one more. So FY21 you did 17 margin. So whatever you have stated, you are saying that FY22 and beyond that, margins will be at least 17.5 or more. Is that understanding correct?
No, that's not what I'm saying. I'm saying that there were multiple reasons for margin expansion, whether it was pricing power, product mix, or inventory gain, and better cost absorption because of the kind of growth we had. And I'm simply saying we need to continue working on those levers the way we have.
Right. So, but in terms of range, if you can help us, what kind of range we should consider for annual margins going ahead?
So, it's hard to give guidances, and we've always been conservative as a company. I understand what you're trying to get at, so I think 13 to 15% is something that we have always guided at, and I would like to stick to that. And then we are happy to keep working and trying to exceed. We are not happy with 13 to 15, and we want to always, strive to improve, whether it's on the top line or on the bottom line.
Right. In terms of annual volume, so that will at least do whatever volumes you would have done last year. Is that base assumption correct?
I think, do I think it is possible? Yes. Do we want to? Obviously, yes. So we need to keep working on, I think, rather than speculating on what the annual number would be, I think we need to put our head down and focus on, network expansion, invest in branding, trying to create a further pull for our products across that. And, that whatever results are going to be is going to be a result of that process. So, of course, is it possible? It is very much possible.
On
a 100 basis. So what would be the reason for the same?
I'm unable to hear you.
Sir, Q4, your employee cost for the quarter was around 27 crore. And in this quarter, it is at around 21 crore. So what has led to decline in employee cost on a QOQ basis? And how we should look at this number going ahead?
So I think employee costs will remain, uniform. I think in the last quarter, there are usually some incentives that is there for the team based on a strong performance. There has been no layoff or no salary cut or anything. This is just something that it's usually there linked to the performance in the March quarter. And I think this is nothing as a cause of concern for layout or salary cut or anything.
Okay. Thank you and all the best.
Thank you, Chirag.
Thank you. The next question is from the line of Dhaval Shah from Girik Capital. Please go ahead.
Yeah. Hello.
Yes, sir. You may go ahead.
Yeah. Sir, how is the demand scenario after the second lockdown? What sort of year-over-year growth are you seeing currently?
So I think we're moving in the right direction. June was better than May, and July has been much better than June. And a few reasons for that is channel inventory was very low by the end of the quarter, and we have just started seeing an increase in the PVC pricing.
Okay.
That is at the channel level, and at the end user level, I think as the guidelines ease, the demand has started to normalize. Real estate is showing that kind of positive momentum. So we are confident of returning to our strong growth momentum going forward.
And typically when the prices are rising, generally the channel inventory, so the distributor network would tend to stock up more?
Correct.
Okay. And would you be confident of achieving at least a high single-digit kind of volume growth over FY21 base, looking at the scenario currently?
So, I am optimistic about the demand scenario. Is it possible? Yes. But, I don't like to speculate on these numbers. I think, like I said earlier as well, we just need to focus on network expansion, branding, creating a pull for our products, and then the results will take care of itself. So we need to focus on the process, and then the delivery will happen. And I think the environment is definitely improving from a demand point of view.
Got it. Sir, if we adjust the EBITDA margin for the inventory loss, so it would be around 14.5% for the current quarter, for the Q1?
Yeah, 14%.
14%. Okay. So then inventory loss was the only one-off expense, and then the operating deleverage which you had because of the lower volumes.
Yeah.
Okay. And are you back? So in the fourth quarter we had a higher advertisement expenditure one time. So on a run rate basis now, from the second quarter, since things are normalizing again, what sort of spends would you be doing?
So I think 2 to 3% is what we have always done. And that is something that as demand normalizes, we would like to continue.
Okay. And so the last question again on the advertising. Now, the way of advertising, like the piping industry had adopted different ways of advertising, but now after COVID, as many people have shifted to digital, so what is the piping industry and your company in particular adopting? Are we again going back to those more non-digital ways, or are we more digital, or what is it?
Yeah, that's a good question. Definitely the focus on digital for prints has been increasing. I would say that has been a shift even before COVID that was happening, but after COVID it's happening in an expedited way. The way we are using the digital landscape to reach to our influencers and our end users to create that sort of brand equity and brand perception. I think the traditional mediums still have some power, whether it is to do with retail boards or plumber meets and workshops. Our loyalty program Udaan is strengthening from here on and helping us improve our touch points. And the digital play helps us across urban and rural. So that focus will definitely keep improving.
Sir, sorry to interrupt, but when you say digital, your end customer...
Sorry to interrupt, sir. I would request you to rejoin.
It's a continuing question. It's not a new question. So is it, are they able to connect with it, or is it only through the phone, or it's through some other medium?
So I think it's multiple mediums. One is definitely social media. is a key way. And this is not like a transactional, right? No one is going to come online to buy a pipe or fitting. It is more to create a certain level of awareness and brand power. And today the key influencers are retailers and plumbers. In some cases in rural India, it could also be the individual homeowners. So we have to target across these segments.
Thank you. Ladies and gentlemen, please limit your questions to 2 per participant. Should you have a follow-up question, would request you to rejoin the queue. The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity. I have a couple of questions. First is, just wanted to understand in the marketplace how we are going about pricing specifically on the CPVC side. Given PVC prices have moved up, I understand from the larger distributors that Lubrizol has been seeking a price increase. And speaking with the channel partners, again, what we understand is our pricing has been a discount to peers like Astral. Now, in a hypothetical scenario, if Lubrizol does seek a further increase of 10-15%, what would it mean on our strategy on market share versus spreads? And that's the first question.
Sure. Thank you, Ritesh. So firstly, the CPVC price hikes, if are going to be industry-wide. It is not going to be only from one particular supplier, whether it is Lubrizol. So CPVC right now, I think pricing is definitely one, and I think across the 3 major global suppliers, there have been price hikes that have happened over the past few quarters. And that could maybe continue. But I think the main point here is about supply. Today, if you see, we were talking about a few quarters ago, smaller players were struggling to get access after the anti-dumping duty, access to raw material. Today, larger players are also unable to get supply of raw material. So today they do not have the supply security in the marketplace. So price is only going to be on paper unless you're actually going to be able to sell. So today, not only the smaller players, but larger players also are running here and there for product, whereas today we are in absolutely strong position as far as supply security is concerned. And any price hikes, will be industry-wide. It is not, something that is going to be unique to one supplier or one partner, because the dynamics at the end of the day are same.
Here, given the peer set has captive compounding, I think we also used to do captive compounding earlier, so you would appreciate that they have a benefit on the cost side. So even if it's an industry-wide increase, obviously the increase what we will have given we are procuring a compound from Lubrizol, our costing will be higher. And that one has to look at or appreciate in conjunction with the discount at which still we are selling it to the peer side. So does it still mean market share loss, or are we looking at spread contraction going forward?
So Ritesh, let me repeat maybe in a different way that yes, we are at a premium in terms of our cost, but that delta I don't think has moved significantly, because when we signed up with Lubrizol a year ago, there were still these other players who were buying resin and making it indigenously, and that holds true today as well. So I don't think that delta in our costs has moved significantly. Cost has increased for everyone in a proportionate manner simply because it is a change in the industry dynamic which has led to these increase in costs. It's not something that is specific to one supplier or one particular vendor. So I think what the dynamic was, a year ago when we did the partnership, it's a pretty similar dynamic. The delta in terms of the finished good pricing has reduced to the market leaders. I'm sure you would appreciate that we have not been a first mover in this space, which is why we had to sell at a discount. But that delta has significantly reduced on the finished goods side, which has helped us find a balance between market share and selling profitably.
Thank you. The next question is from the line of Achal from JM Financial. Please go ahead.
Yeah, hi, good afternoon. Thank you for the opportunity. So my first question, with respect to inventory, I think QOQ, we have seen a significant increase in the inventory. So the question is it to do with the raw material or is it to do with the finished goods?
It's a split of both, Achal. And as the demand normalizes, the finished good inventory would normalize. So it's been an increase both in raw material and finished good inventory.
Understood. And with respect to first quarter, what is usually the agri mix and what was it in this quarter? Would you be able to give some color on that? Even we have seen a substantial drop in volumes.
Yeah.
If you could help with that.
Sure. So agri being muted has not been the only reason for the drop in volumes, but it has been one of the key reasons. Usually for us in quarter one, agri would be around 38 to 40%, which in this quarter has been around 30%.
Right. And with respect to this supply security perspective for the PVC, what has driven this? We were hearing that some of these facilities in US and Europe were restarting about a quarter back. So what is it that is driving this, availability part of it? And how do you see it evolving actually when you say the prices are bound to remain kind of firm or go up from here on?
So, Achal, supply security today is a challenge both in PVC and CPVC is the point I was making. Specifically coming to PVC, I think it's multiple factors. Like you correctly said, yes, there was a delay in supplies globally. And that is, even as that has improved, that has not impacted the Indian PVC pricing for two reasons in my mind. One is out west, whether it's North America, Europe, Latin America, inherent demand has been very, very robust for PVC. So they are choosing to sell locally and not export as much. And freight costs globally have, I'm sure you would be aware, have gone up in multiples, which have kept this pricing buoyant.
Understood. And if you could give some colors in terms of the, the B2B part, post the tie-up, have we started realizing that benefit? Is it there in the quarter numbers or we are yet to see any meaningful contribution as yet?
So right now, I think B2B, we are more, I would say, trying to, we are sowing the seeds right now. So we are in that process as we are building the team, building the relations with the key stakeholders in that segment. So I think it would take a few quarters for that to realize, but the process is going on currently.
Understood. And just one more, if you could give some color on the water tanks and the valves, where are we, how are we looking at, and what kind of, I know it may be a little early to ask, but what kind of contribution can we look at from these two pieces, let's say next 3 to 5 years, can it be like 10%, 15%, or could be less than 5%? Some range.
So tanks is something that it was a natural extension to our product portfolio, but I don't think it's going to be a major driver for growth. It's still early days, so hard to comment on how it would be as a percentage of the overall revenue. But one needs to be sort of conservative, simply because it's early days and we're trying to establish ourselves. The feedback on the product and quality continues to remain encouraging, and we are looking to further penetrate in this space and cross-sell our tanks with our pipes.
Thank you. The next question is from the line of Sneha Talreja from Edelweiss Securities. Please go ahead.
Thanks a lot for the opportunity. I actually just wanted to understand about your new product. So actually in your commentary remarks, you also said that some part of sales is already happening for PPR. Could you tell me what sort of a sales is happening for PPR? What would be the percentage and what would be the readily available channel for us in that case? And secondly, which are the players currently which are supplying in this market, whether it be domestic or any global player or any import? That will be helpful.
Sure. So PPR in the industrial, we have a decent distribution network. PPR also in India still is largely for plumbing in certain pockets. So industrial is still not that developed. We are still relying on traditional products. I think plastic pipes are still being penetrated, or have some further room to be penetrated in the industrial space. And today in India, if I look at the CPVC industrial space, there is only maybe one player in India, and there is not much. It's not easy to import simply because of the freight costs. So I am seeing a very good adoption curve that we can drive in this space simply by looking at what is happening globally, and the kind of challenges that there are with the conventional MS pipes today. I think there is a very good scope for this product.
So just an extension to this, you said that globally we generally India generally follows global trends, like we followed in case of DWC, and you came in 2017. Now we are following this. Which are other segments which can be part of our growth journey, maybe going ahead, or even for the industry? So if you can highlight some of the global trends which you are seeing and which we or any other peers could later follow in terms of getting the demand.
Yeah, so I think you're right in saying that we have been late in the adoption curve, and it has to be leaders like ourselves who have to drive this change in the industry, and that started with DWC and now with industrial CPVC Corzen. Now the focus has to be on nurturing this product for the next few quarters, and only then would we like to come into a newer product. And I think let the action speak louder than words, and when we come into that product, we will talk about the potential and try to be a first mover in many more segments from here on.
Thank you. The next question is from the line of Devang Patel from NAFA Asset Management Company. Please go ahead.
Hi, my questions are on industrial CPVC pipes again. So globally, what is the penetration of these pipes versus MS pipes? How old is the technology? And in India, over 5 years, what kind of penetration would you expect in the 16,000 crore market?
Yeah, those are all good questions, and sort of hard for me to answer at this point. All I can say is today in India, CPVC, more than I think 90% or 95% of CPVC, in my understanding, is used only for domestic application, and it is very skewed towards domestic plumbing. Whereas globally, industrial and domestic both form a pretty good part of the overall CPVC consumption. So simply by looking at that, I think now it's just a point of concept selling in India, which is not easy. It is going to have its gestation period. But we are willing to do that because, the harder it is, the higher the entry, barriers to entry in the segment. And, if we are, I'm fairly confident simply because the product is so much superior to the conventional solution. So if we are able to do that concept selling, nothing stops us from having high double-digit growth for industrial CPVC from here on. Again, it may not be a very significant part in terms of contribution to the top line, but it is going to be extremely value added at the gross margin level.
Are the BIS certification norms established in India for these kind of pipes, and has anyone before this tried to introduce them?
So like I said, there is, one other player in India, but largely still this space is dominated by mild steel pipes. And, the Corzen product of Lubrizol is beyond, any standards and specifications. I think Lubrizol's own standards of quality and safety are much higher than, any standards. And this is a product which has been very well accepted by consultants, industrial consultants.
Thank you. The next question is from the line of Praveen Sahai from Edelweiss Financial Services. Please go ahead.
Yeah, hi. So my question is just a clarification, as you had already mentioned that channel inventory is down and
your inventory level has normalized. So it's fair to assume your inventory went back to the fourth quarter level?
So inventory is not yet normalized, but as demand picks up, it will normalize in the coming time.
Mm-hmm. Okay. The second question is, as I can see that the sequential volume degrowth in Prince is relatively more as compared to peers, whoever has given their numbers, and as well as your EBITDA per ton is also more, seen correction on sequential basis. So can you give some, enlighten me to differentiate these numbers?
Sure. So I think in our industry, firstly, I understand why you're looking at QOQ and maybe not YOY, because the YOY base also was impacted by COVID. But in our industry, I think QOQ is never the right comparison, especially March quarter to June quarter, simply because the dynamics are so much different for agri and for plumbing as well, because quarter 4 is a quarter where all the distributors are gunning for their targets and so that they can achieve their incentives. Like I said, there were 3 main reasons for the volume degrowth for us. 2 were industry-wide. One was the muted agri demand, and second was the lockdown having an impact. And one specific to Prince was the channel inventory being very, very high at the end of the March quarter, which was a strategic decision we took. And we had said that in the last conference call as well, that that was one of the learnings that we had from the last lockdown. We wanted to have no supply chain issues and have plenty of product available in the market, and which is why we were outperformers in the March quarter. That would have been seamless, but because of this muted demand, it has led to a sharper drop. But we have moved in the right direction. June was much better than May, and July has been, we have returned to our growth trajectory.
Okay, great. Thank you. Thank you for taking my questions.
Thank you.
Thank you.
The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Hi, if I may, I just wanted to continue with my prior question. Nihar, what you indicated is that our discount versus the market leader has reduced. Is it possible to quantify it? I'm just trying to understand what our strategy is in the marketplace.
Yeah, so I think if you look at few years ago, it was high single digit or in some cases even a double digit discount to the industry leaders, which now in some markets would be around 3 to 4%. In some markets it would be at a parity as well. So that has sharply reduced, and we have been able to grow over FY21 over the 4 quarters of FY21. So we have to, it's a balance between market share and profitability, and we have to keep monitoring that.
Okay, so on CPVC, basically our cost curve is a bit higher, but we are still at a bit of discount, and the discount has reduced over time, right? Would that be a fair conclusion?
Yes.
Okay, that's helpful. My second question is on the PVC side. You indicated that we are not worried about inventory losses. I think this question is for most of the polymer processors in the country. I digged out certain data wherein I understand for April, May, and June, the cumulative resin imports what we had was around 27,000 tons, and the average pricing was around 125, 128. Now, if one looks at the Reliance current pricing, it's below $120, including volume discount. So I have a twofold question over here. Why is that we have moved to imports? Do we not have a MOU with Reliance to procure material locally? That's one. And secondly, looking at the average inventory cost what we have, wouldn't it mean that we are looking at inventory losses? Now, this is not something to Prince. We have been asking this question to across companies as well, just trying to understand what the sourcing strategy is and the quantum of inventory losses that one can look into the next quarter.
Yeah, that's a good question. So firstly, in terms of supply security, we have domestic contracts with both the large PVC manufacturers in the country. So one of the largest PVC processors in the country. We do have those dependencies both on import and domestic. And supply continued to remain a challenge, which is why we had a good amount of inputs like most of the large processors would have. And if there was no, second wave, I think we would be in a very strong position. There will not be major inventory losses going forward because PVC has started going back in an uptrend, and we have both local and import, which helps us control our cost quarter to quarter while still having strong supply security. Similarly, like CPVC, in PVC today there are few players, both small and large, who have supply chain issues, and we do feel that we have the pricing power, being one of the strongest brands in PVC, to return to our sort of regular margin levels.
Thank you. The next question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Yeah, hi, good afternoon. Thank you so much for the opportunity and congratulations for the OneFit Cordon launch. I had two questions. Firstly, on the demand sustainability side, right? I mean, there've been so many questions largely on how is the demand shaping up for building materials in India and especially for pipes. I'm just trying to understand, could you help us with some lead indicators which you track internally, maybe which builds on the conviction that the demand is going to be sustainable, both from housing or project demand or even from government, and that could be across plumbing, SWR, or even agri pipes for that matter. So I'm just looking for some more color, any dealer feedback you could share, which you get from your channel, essentially highlighting, okay, this is what is moving faster than the other, and overall the next 12 months look like that. That's my first question. Thank you.
Yeah, thank you, Ram. So yes, we whatever distributors that I've been talking to or markets that I have visited, even at the retail level, there has been a return in normalcy. So even if you look at larger picture data, the kind of performance the real estate sector has been seeing in terms of registrations, especially in metros, have improved. And whatever few developers also that work with us, there has been an underlying buoyancy in demand, and I think it was of course impacted by the second wave, but I think that still remains, and that will come to the front and center now as the economy normalizes. And I think the kind of direction that our performance has seen month on month, like we said, that June was better than May and July has been much better than June. So that itself is the lead indicator that demand is going to improve from here on, and that direction has already started moving. Also, channel inventory was very low at the end of the quarter, and with the increase in the PVC prices starting, I think that will be a further boost for the demand.
So if I understand it correctly, basically we have to look demand more in short term, right? As in month on month behavior basically helps us build more conviction. There is no way out. Could we build like a 12-month view on sustainability? Is it even possible?
So, I mean, the accuracy could not be that high for a 12-month view, especially in the current sort of uncertain economy. But if you're asking me for a medium-term view, I'm still optimistic, because real estate had started to see that turnaround in the December quarter and then in the March quarter. And I think this was just a blip. I think that underlying buoyancy will continue to deliver. If you're asking for my opinion on a 12-month basis, I'm optimistic.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Rajesh Ravi from HDFC Securities Limited for closing comments.
Yeah, hi. Thank you everyone for joining in this call, and thank you to the management for taking all the questions. I would now want to hand over to Parag sir for his closing comments, if any. After that, you can conclude the call.
Thank you, Rajesh. Thank you to all the participants. Stay safe.
Thank you. On behalf of HDFC Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect.